Hi, fellow traders. It's Larry Williams back here at Stockcharts.com. I want to talk about what's next. Way back when I was in high school, back in the 1955 time period, I had a sports column called As I See It in our weekly Coyote newspaper in Billings, Montana. And I want to really get back to that idea of what's next. And let's see what I think's coming because there's some big changes coming in the markets. 2 months ago, I said it was rally time. A lot of you watched that. And it's kind of interesting what happened from that time period forward. This was a chart we showed back then. I talked about this red wave in the market. It said around the end of March, first part of April, we should start to move to the upside. That was the bullish wave that I was looking for back then. And that wave has started to come true. But boy, did we get comments from the last stock charts thing I did, like, wow, this did not age well between I began shorting in January. A Great Depression is coming. Larry's obviously wrong. Larry was extremely wrong about this market. Yeah, I was. But we remember the first of the year we talked about this being a Clint Eastwood market, the good, the bad, and the ugly. Well, we've seen kind of all of that this year. We did see a big rally from the last post that I did, but the bad part is still kind of hanging with us, and I want to talk about that today. 2024 is too strong. What will tariffs do? And that's become the big issue, obviously, and an unwilling Fed. I'm going to talk a lot today about the Federal Reserve and what I think they're going to be doing with interest rates. The big problem that we saw at the first of the year was that PE ratio spelled trouble. This is from the presentation I did last December, that the current P at 38.5 is 54% higher than the average, indicating that we should not see substantial rallies in the stock market. And as you know, we didn't until the sell-off we saw in March of this year. If we look now, though, the PE ratio is a lot better now than it was back then. It's now 23.5. A year ago, it's 27.8. In fact, the P ratio now is supportive. We now will underperform by less than 1%. In other words, we can now expect about typical stock market returns. So typical stock market return has been about 10.4% on a long-term basis. And this is the area we're in now. We're out of that ugly part in terms of PE ratios. We'd also talked about in that presentation at the end of the year, that low that we saw coming in the March time period. And that's really what has happened. This is when I last did a stockcharts.com. So you had plenty of room to buy on weakness, right? I know very hard to buy on weakness, but that's when you have to buy. And this is what's rallied since then. So we've had a pretty good rally in the market, which leads to the question of where now, what next? And what's going to be driving this market, I believe, is the Federal Reserve System. So I'm going to get into that quite a bit. We gave some specific stocks back then. It's interesting to do a little follow-up on these stocks to see exactly what helps us identifying stocks that are going to rally. These were the four we talked about in that March report that I did, calling for bottom in the marketplace. Where this was Tesla, as you recall, my accumulation distribution on Tesla went from a lot of distribution to a lot of money flowing into this market. And of course, Tesla's rallied from about 220 to 350, a really nice rally in the stock. Interesting, right now, we're not down. We have not seen a lot of distribution in this market yet, telling me that the trend of this market should continue to be to the upside. When we see a lot of selling in the market, that's the time to get intrigued about taking profits, or if you're a short seller, sell short. We also talked about XLP. This is essentially an ETF of funds. So it doesn't move as much as an individual stock, but it also had a nice rally from 76 to 82. There was a lot of buying back here, and we've been in the sell area. Now we're kind of mixed, not under accumulation in the market. Expect this market to follow the overall market. Nvidia, we talked about in the 90 area, well, it's gone to about 130. Again, notice though we saw this accumulation coming in. This is my money flow index. It's in stockcharts.com. And we saw a lot of accumulation in Nvidia, and it's had a big rally. And again, it's not in the distribution area as it was back here. So another stock that's positive, and we can expect buy pullbacks and look for this market to move higher. Apple had also come under accumulation, and we talked about being a buyer in Apple. It's gone from about 175 to 210. I would think this market, because it is again under accumulation, there's distribution in the market, right? We had accumulation back here, is a positive factor for this market. Well, that was then, this is now, right? So the past is prologue, but what's going to happen in the future? Well, It's very difficult to precisely predict the future, but we can get pretty close with some ideas. The big question, I think, right now is when and if the Fed will lower rates. That's what I want to talk about today. Are they going to do it? Will they do it? And maybe we can get an idea of when. So let's look at the data on the Federal Reserve System. Um, when will they lower rates? Will these tariffs that Donald Trump's going to do cause higher inflation, assuming he gets tariffs run through? And then finally, what's in store for the stock market? I'm going to give you a specific stock market forecast in just a few moments. Well, the Fed mandate, and this is important. Years ago, when I was heavily involved in politics, I thought the Federal Reserve was this thing concocted by international bankers, whatever. I bought into all the conspiracy in the Federal Reserve System. What I think I've learned since then is the Federal Reserve System, by and large, has done a pretty good job. We have not seen any major depressions. We have not seen any major recessions. We have ups and downs in the economy. We have not had a depression like, say, the depression in the 20s or even in the 30s and the 40s. We had some really bad times. They've done a decent job of moderating the economy. Their congressional mandate is to control inflation, that's basically the CPI index, keep unemployment levels low, in other words, create jobs, and have a stable economy, the GDP. These are the three driving forces of the Federal Reserve. I'm going to go into each one of these individually today so we can get an idea based on what this is happening in these areas, what the Fed's going to do with interest rates. Oh, the Federal Reserve System, right? Well, it's kind of interesting. You know, it's the interesting triangle of the Federal Reserve. We, the people, we're at the bottom of this whole thing, right? The Board of Governors and the Federal Open Committee, they're really controlling interest rates, the Federal Reserve System, all that stuff. And, you know, there we are down here at the bottom. There's not much we can do about it, but we can learn. This is something that's going to shock you. This is not what you expect to find. We're looking at the black is interest rates and the blue is inflation, CPI index. And notice that interest rates peaked prior to inflation peaking. Interest rates peaked prior to inflation peaking. Here they peaked about the same time. Interest rates peaked prior to inflation peaking. Interest rates peaked prior to inflation peaking. Wow. That's not the way it's supposed to be. You would think that after inflation is under control, then interest rates would drop. But in actuality, we see that has not been the situation. We can bring this right up to date and we see the same thing. Here's interest rates peaking. Inflation peaks later. Here they peaked about the same time, a big drop in inflation, but interest rates had already started to come down after the peak in inflation. And we see the same thing in 2019. Interest rates started to come down. Inflation peaked later. I mean, that's just kind of not the way it's supposed to be, right? It's not what it seems, but that is the way that it actually is. So we can start to look at a couple of other indicators to give us an idea of what interest rates are going to do. This is a good one. The red is the year-over-year 12-month rate of change of employment, not unemployment, but employment, percentage of the people in America that are employed. And by the way, you know what I've done? As you'll see in a moment, I moved this red line forward a little bit. In other words, we led at employment to predict interest rates. Notice unemployment comes down here, they drop interest rates. Employment comes up, more people get employed, they increase interest rates. Employment starts to come up, they increase interest rates. People start to lose jobs, they decrease interest rates. I think there's more relationship between employment and inflation or interest rates than in just inflation. Here we see again what's happening in the market. Like unemployment starts to go down, they drop interest rates. Unemployment starts to pick up, they increase interest rates. Unemployment starts to go down, they decrease interest rates. A lot of people don't have jobs, they decrease rates. As soon as people are getting jobs, look what happened. Interest rates go up. Interest rates go up. Fascinating. I think this is one of the points the Federal Reserve really focuses on. And now we're bringing this right up to date. We can see where we are now. Again, notice as people are losing jobs, they drop rates. People are losing jobs, they drop rates. And I've extended this in the future, as you can see. And you can see this also suggests lower rates are coming. The Federal Reserve should be motivated by the fact that we're not having an increase in jobs as we were here and here. And this is another reason for them to start to lower interest rates. The other thing, of course, the Reserve is responsible for is a decent, good economy. So we can look at interest rates, again in black, versus the gross domestic product. That's in gold. We see a pretty tight relationship between those two. Again, interest rates have a huge effect on the economy, but we can also lead that forward. And if we lead that forward, we see the same thing. We can predict interest rates based on the GDP. When GDP starts to decline, they lower rates. GDP declines, they lower rates. This is a good forecaster, and this is where we are now. You can see another indication. So we see based on inflation, we see based on employment, and we see based on GDP, it's time to expect the Fed to lower rates. The problem, though, is I think what they really look at is current market rate. That's the blue line. Notice how closely they parallel each other. The black line, of course, the federal is a discount rate from the Federal Reserve. The blue line is the actual market itself, what the market's doing. And that's the rub the Federal Reserve has been in recently. Again, I've led the blue line, so it's a forecasting, it's forecast the peak, forecast the bottom, a pretty good forecaster, as you can see here. And this is where we are now. Clearly, when it peaks, they start to lower the discount rate. When the blue line is coming down, they lower the discount rate. When it comes up, they increase the discount rate. Well, this is where we are now, been very choppy. I've advanced this by 4 months, so I'd have a 4 month lookout in the future of what should happen to the discount rate. It suggests that the Federal Reserve is going to really look at the bond market before they make the next major announcement. So I think this is the key point. If you start to see a bond market rally in here, it locks it all together. We've had lower inflation. We've had people losing some jobs. We've had the fundamental conditions for the Federal Reserve to lower rates. And the timing of it, I think, is going to be once we see the bond market turn the corner, and it's started to do that now, that's going to be the aha. The Federal Reserve will lower rates, and then you can take advantage of exactly what that means. So we'll look at each of these individuals in terms of the cycle too. Where are we in terms of the discount rate? This is the discount rate, and this is the cycle of the discount rate. This suggests also that interest rates should come down until about 2028. This is a long-term cycle, low in interest rates, low in rates, low in rates, low in rates, and high in rates. So a pretty good idea of the cycle or cyclical phenomena of the discount rate, and that also suggests lower rates are coming. Now, here's another market myth we want to dispel. If interest rates go up, that's the discount rate. Stocks shouldn't rally. Well, they did. Big increase in interest rates, stock rallied. Massive increase in interest rates, stocks rallied. Even back before 2000, big increase in 2010, I'm sorry, and big rally in the marketplace. Big increase in interest rates, Federal Reserve, and stock prices rally. So clearly, stocks can rally with higher rates. Higher rates are not the only thing driving the market. They certainly do help when rates come down to set up market bottoms. We know that. But what me worry about higher rates? Oh, I love old Alfred E. Newman, right? I'm not going to worry too much about higher rates because we know stock can have gargantuan rallies when rates go higher. So what me worry? Not much about that. Well, here's our GDP cycle forecast. What do we expect for the gross domestic product? Are we going to be in a down move or an up move? Well, here's my cycle forecast. What does it look like to you? Cycles are telling us GDP is going to turn the corner here and go up. That's also bullish. Not all that bullish for the stock market because, believe it or not, as I've discussed before in these presentations, there's not a lot of relationship to show the stocks are the same as GDP. Oh, there's some correlations, there's some relationships, but clearly there's a good Federal Reserve paper on that, by the way, if you want to Google that. GDP is not the stock market, but it's an indication of the economy. And it looks like the economy is now going to get better as we're in the area of cyclical low. Now let's look at inflation forecast. Way back here, we started to predict inflation would come down in my annual forecast report 4 years ago, and it's done that. And it should continue coming down until about September 2026, sometime next year. This pretty strong cycle in inflation when it's going to get high, when it gets low, and this is where we're coming now. So I know we might have tariffs, they might change things, but by and large, the rate of change of inflation, even with what's happened recently, suggests lower prices are coming, or at least stable prices. The rate of change of prices will not be as extreme as it has in the past, and inflation should continue declining until sometime late next year, the middle or the latter part of next year. So that's our cycle forecast. All the cycles are pointing to the fact that we're not going to enter a recession. And here's the last one to look at, the employment cycle. The employment cycle, the black line is people being employed. Remember, in COVID, nobody had jobs, and they got jobs back again. The red line is the cycle forecast of employment. So we have peaks about here, and we have one coming up, but not yet. What I did notice, and I've circled in green here, when we had this strong uptick in employment in the cycle, that's right here, over here was right here, over here was right here. We're coming into that a little later this year where employment should start to pick up, which would also be powerful, bullish to the stock market. So when we look at the key drivers that the Federal Reserve is looking at, whether it's interest rates, GDP, inflation, jobs, we see that there's no reason for them not to cut rates. Well, okay, so let's cut to the chase. What about right here, right now, Larry? What does the future look like? Well, let's go look at the future. This is a general idea of what I'm expecting in the market. This is what I call a pattern from the path. The market is pretty much following this pattern from the path, and you see a bit of a rally in here, another pullback, but overall, the trend should continue to be up at least into October. So is it a time for fear and panic? No, not based on this pattern from the path. Choppy, yes, but choppy to the upside. We can look at that on individual stocks as well. Patterns from the past show what should be happening in stocks. And I forgot to put, I believe this is Tesla. Sorry, I should have had that up there. But we see again another of the high-flying stocks should continue rallying. Nice rally up, another buy point around the first part of July. Here's Google, pretty much the same thing. There's a pattern from the path that this stock has been on. I believe will continue to be on that pattern. So bullishness in a couple of really important stocks here is Nvidia. There's the pattern from the past that's been responding to quite well, a little higher, pull back and around the 1st of July again, rally back to the upside in Nvidia. These are the patterns that these stocks have followed. I see no reason why they won't continue to follow those patterns. And here's Apple, pretty much follow the pattern from the past. Now, it's not perfect, but it shows that when there's tops and when there's bottoms in the market, and you can see what it says, sideways for a bit, but around July again, we should start to move back to the upside in the stock. So we've got a pretty good idea from the past of what we should see in the future, and that's really what traders need to know about. Finally, we'll look at old Facebook or Meta. Here's the pattern from the path, the pattern this market has been on. Whoa, nice up move into July. Then a pullback. We'll have to look at that when we get into July. But between now and then, interesting in all these stocks, these patterns they've been in, and this has been a pretty reliable pattern, they've continued to the upside in each and one of these patterns. And these are the major stocks in the stock market. I think it's another reason to stay bullish on the markets. Oh, and here we have Tesla. You can see what Tesla's doing here in a buy point, rally up, pull back, and another rally. That rally in Tesla started about the end of July and move back to the upside. Current rally should go into the middle of June, the first part of July. Again, we see a lot of positive action from individual stocks. So it's nice to have a forecast, and you might want to review this presentation. Go to the very first chart I showed you, the red line, the wave that I saw when we did our last forecast before the market bottom, that we moved to the upside. And I think that's going to be true. Now, let me be clear. Will the market follow this pattern precisely? No. Does it give us a good idea of when to rally and decline? Yes. I am not perfect in this business. Nobody is. Don't expect me or anybody to nail every single turn in the market. It's just not possible. Why? Because there's two types of questions. Hard questions like, what's the capital of California? Sacramento. How many people in California? Whoa, that's a soft question. There's so many different answers. Well, today, yesterday, tomorrow, it's going to be changed. So the market is full of soft questions. There's a lot of different answers that could come, and that's why the market's so difficult. But Everybody wants red arrow, green arrow. They want a hard question buy sell. After you've traded the markets as long as I have, 63 years now, something like that, you realize there's no absolute hards and question, but there's some guidelines and paths we can follow, then use our natural intelligence or our skills to take advantage of those projections in the marketplace. Well, I hope that give you some insights into what I think is going to happen as I see it, the future. A pretty good idea. It's not the end of the world. It's a time to look to be long individual stocks of your choice, and retest of the lows. No, I don't think so. I think we're going to see higher stock prices. So that's Larry Williams, and that's how I see it. Until next time, I'd like to thank everybody for watching this, for your comments you post. Thanks for doing that. And above all, it would not be possible to do this without Stockcharts.com. So please make certain you support them. Until next time, then, as always, Larry Williams wishing you good luck and good trading.